So you're holding crypto and you know it's valuable. But what if you could tap into that value? Get actual cash without ever hitting the sell button? Well, that's exactly what we're breaking down today. We're talking crypto-backed loans. Let's get right into it. Here's the classic problem, right? You need some liquidity, maybe for a big investment or a purchase, but selling your crypto could mean facing a pretty hefty tax bill. This is the exact situation where a crypto-backed loan becomes a real game changer. All right, here's our roadmap for this explainer. First, we're going to talk about the whole idea of unlocking your crypto's cash. Then we'll define exactly what a crypto loan is and walk through the simple four-step process. We'll even compare the two main types of lenders, DeFi and CeFi, cover the must-know questions, and wrap it all up with the final takeaway. Okay, let's kick things off with a big idea here. Unlocking your crypto's cash. This is all about taking the assets you already own and using them to get cash in your hand right now. Think about it this way. Instead of your crypto just sitting there in a wallet, as a long-term hodl, you can actually put it to work. It becomes collateral, which lets you borrow against its value without actually selling the asset itself. It's a really powerful concept. So that's the big picture. Now, for section 2, let's get into the nitty-gritty and define exactly what a crypto loan is and what makes it so different. At its core, it's pretty simple. You use your crypto as security to borrow stablecoins, which are basically digital dollars like USDC or USDT. And the main benefit, the real magic here, is that you get the funds you need while still holding onto your original crypto. You get to keep your position in the market. And what do people do with this borrowed cash? Well, pretty much anything. You could jump on another investment opportunity, maybe in crypto or even real estate. Or you could use it for more traditional stuff, like buying equipment for your business or covering a big personal expense. The flexibility is huge. Okay, here's a key term you've got to know. Loan to value, or LTV. It's just the percentage of your collateral's value that you can borrow. And with some DeFi protocols, that number can go over 86%. That's a serious amount of liquidity you can unlock from your assets. So you get what it is and why you'd want one. But you're probably thinking, how complicated is this? Well, let's dive into the four-step process and you'll see it's actually incredibly fast and straightforward. It's literally just 4 steps. First, you just decide on the loan terms, how much you want to borrow, what crypto you'll use for collateral, and where you want the funds sent. Second, a unique smart wallet is created just for you and your loan. Third, you send your collateral to that new wallet. And finally, boom, the funds are sent right to your account, usually in just a few minutes. It's all automated, super fast, and secure. Now for a really, really important part of this whole thing. Not all crypto lenders are created equal. In this next section, we're going to compare DeFi, which is decentralized finance, with CeFi, which is centralized finance. And trust me, you need to understand the difference. Just look at this table. The differences are massive. Right off the bat, interest rates in DeFi can be way, way lower. That directly affects how much you pay. Then there's custody. With DeFi, it's non-custodial, which is a fancy way of saying you keep control of your keys. That's a huge deal for a lot of people in crypto. CeFi, on the other hand, usually makes you hand your crypto over to a third party. DeFi is also way more flexible. No rigid repayment schedules, unlike the 1 or 2 year terms you often see with CeFi. And to top it off, DeFi is usually available everywhere in the US, while many CeFi lenders are blocked in certain states. All right, next up, we're going to tackle some of the most common questions people have. Think of this as a rapid-fire Q&A to cover the stuff you really need to know before you even think about getting one of these loans. First up, the question that haunts anyone who's ever dealt with a traditional bank. What about my credit score? And the answer is a big, resounding no, not at all. With DeFi protocols, there are 0 credit checks, no hard pulls, no soft pulls, nothing. Your loan is based on your collateral, not your financial history. And since they don't report to credit agencies, your score is completely untouched. Okay, next question. Let's talk about risk, because it's super important to understand the worst-case scenario. What happens if you can't repay the loan? So if the price of your collateral drops and your loan-to-value ratio goes up past a certain point, called the liquidation threshold, your collateral could be automatically sold to pay back the loan. But, and this is key, this is totally avoidable. You just have to monitor your LTV, and there are even tools like email and text alerts that can warn you if you're getting close, so it's a manageable risk. And finally, let's circle all the way back to the question that got us started on this in the first place. What about taxes? So, as of right now, under current IRS guidelines, just borrowing against your crypto isn't a taxable event. Why? Because you didn't sell anything.
But, and please hear this loud and clear, tax laws can be complicated and they can change. So you should always talk to a qualified tax professional to figure out what it means for your specific situation.
Phew. Okay. We have covered a lot of ground. We've defined the loan, gone through the process, answered the big questions. Now let's wrap this all up in our final section. So who can actually do this? Well, that's the cool part. It's incredibly open. Businesses, entrepreneurs, individuals, pretty much anyone. The criteria isn't about your credit score or your income. It's all about the assets you own. If you have enough eligible crypto to back the loan, a wallet to use, and you're in the US, you're basically good to go. It's a totally different way of looking at lending. And all of this leaves us with one last really big question to chew on. When you can instantly borrow against an asset you own, with no credit checks, no banks, no long applications, what does that really mean for the future? We're seeing a whole new financial system being built, one where the value you've created can be used in ways we never thought possible. Is this the future of finance? Definitely something to think about. Thanks for joining me on this one.